There's a lot happening, and there's a lot happening fast. So let's get right into it. I've been having a lot of conversations with clients, potential clients, and just in general talking about what's happening. And you know what I find? I find that so many times everyone's political beliefs get in the way. I learned earlier in my career that when you lose political beliefs to drive your investment decisions, that is one of the worst things you can do. And unfortunately, we're at a time where I'm seeing that happen a lot. So what's happening? What exactly is causing this? I would reference you to a book called The Fourth Turning. I've talked about this book several times. It's one that I think well over a decade from now will still be a good reference to go back. What's happening in The Fourth Turning is when you got one generation that's basically moving out, moving to retirement, and then the next generation is coming to power. And so what is that? That's the baby boomers today. Baby boomers moving into retirement, and then you got the millennials that are coming into the workforce. And you got that collision right now that's happening. So a lot of what we're seeing is demographics. We've had a huge, massive amount of debt run up, and the dollar. These are three things that are creating this really uncomfortable environment. And if you think about it for a moment, one of the most conservative portfolios that we've seen throughout your entire investing history, we've heard about the balanced portfolio, or better yet, the 60-40, that's stocks to bonds. And we've all known that to be a very conservative portfolio over time. It stood the test of time. This year, the 60-40 portfolio is having the second worst year since recorded data. That should tell you a lot about what's happening. And because we're going through what I said, this fourth turning, the rules change. I mean, just think back to the days where there was gentleman's warfare. We all lined up on the battlefield to shoot each other. I mean, I still to today think that's the most ridiculous thing I've ever seen. However, it happened until one day it didn't. Guerrilla warfare started to occur and people were picking each other off from the trees. That's exactly what we're going to be going through with monetary and fiscal policy. And whether or not we like these change, whether they're uncomfortable or not, it's going to happen. And there's going to be, opportunities, but there's also going to be things that are affected. Right now, because of this transition, every single asset class is affected. There's not one asset class that you can run and hide into, unlike we've seen in the past. In the past, people could run and go into cash. And so that comes down to a question I get asked a lot. Mike, should I go to all cash? Should I raise a significant amount of cash? My answer is no. And here's why. The response to what is happening now is going to be fast and furious. Think about what the reaction was to the pandemic, right? The Fed came in and really couldn't do much, but Congress came in, monetary policy came in. We put checks in the hands of businesses and people. And that money, one of the biggest increases in money supply we've ever seen, changed the dynamics of the market. We went from a fast recession to a recovery. And that is exactly what I think is going to happen going forward. We're going to have fast recessions, fast recoveries. So right now, you're seeing a response to all this debt, this demographics. The Fed has basically told you they are locked in on one thing, inflation. And if you think back, if you ever seen that show, Top Gun, right? You got a fighter jet, it's locking its missiles on the other jet, and it's locked in. Nothing else matters. It's locked in. The missiles are locked. It's going right after that. This is the Federal Reserve we have now. Now, here's the issue. Why is that a problem? Well, we're so used to the last decade. The Federal Reserve has been what? Accommodative. Anytime the stock market got into trouble or anything else, what has happened? The Fed came in, they've stimulated. We had quantitative easing 1 through 4. We had Operation Twist. We had all these programs. I remember as soon as last year, the stock market would correct 2%. Everybody would just go crazy. But that's okay. Jerome Powell, the chairman of the Federal Reserve, and Janet Yellen, they'd come on TV, tell you a couple sentences, the markets would rally back. We have become so complacent that the Fed would step in every time. The Fed is a different person. Jerome Powell doesn't have the challenge of Donald Trump like he did in 2018. And if you recall, Jerome Powell was raising interest rates, and Donald Trump, right at the end of 2018, the market sold off. Over the holidays, Trump called him into the White House. There was many recorded times that Jerome Powell went into the White House. 2019, what happened? Jerome Powell cut rates, and we had one of the best rallies the stock market's seen in a decade. And unfortunately, there was no one to challenge Jerome Powell. he has now lost credibility. So think about that for a moment. The Federal Reserve has lost credibility. Right now, they are trying to restore that. There is a monster ego of trying to be Paul Volcker by the current Fed chairman, Jerome Powell. He doesn't want to lose credibility. He doesn't want to make another mistake. So he's locked in on inflation at the cost of what? Everything, all asset classes. And you're probably wondering, well, why not go to cash? Because the thing is, the response at some point, they're going to let many things break. But at some point, they're going to change course, and that's going to be done fast. And let me remind you, 1913, as a response to the many banking crises that we had prior to, 1913 Jekyll Island, behind closed doors, the creation of the Federal Reserve. Go back to 1973, Nixon came off the gold standard. That was done behind closed doors, the ending of Bretton Woods. You go back to 1987, the Plaza Accord with James Baker, that was done in New York at the Plaza Hotel. And that was because the yen was basically being crushed by the dollar. Like many of the emerging currencies are today, as we've seen the UK here in the last few days, the yen back in the same situation. What typically happens at this point is we're not going to let, and our trading partners are not going to be happy with their currencies being crushed under the dollar. At some point, something will give. Most likely, this could be done behind closed doors again. And the response of the markets will be fast. You will not time that. So ultimately, at the end of the day, how do you protect yourself? What is it you got to do to protect yourself? Well, the best thing you can do is, number one, have a comprehensive financial plan. That is something we make sure all of our clients have. That plan is going to allow you to track and make sure you're staying on course for your overall goals. So that for one. Number two, a good financial plan is going to help you look at the asset classes and how they are in your portfolio and whether or not you should increase risk, decrease risk, whatever it may be, but allowing you to make good financial decisions. Right now, one of the things I would challenge many people on that are sitting on cash is probably likely putting some of that cash to work. The risk side of your portfolio, so think about that for a minute. The risk side being the stocks, being the equities, the longer term assets. Those have gone down probably the most. This is not the time to abandon those, okay? This is the time that you probably need to keep whatever percentage you're supposed to be at, keeping that percentage at that level. So that means probably add more to it. And I would challenge many people that probably increasing your risk, if your financial plan allows, and this is what we do for a lot of our clients, we'll see if increasing the risk improves your overall long-term success. And when things are on sale, I mean, you can think of how many stocks right now, they're down 30%, if not more, from their highs. Things are on sale, but when things are on sale, nobody wants to buy. Everybody wants to buy at the top. The time now to buy and add risk makes a lot of sense, but the way to do it is dollar cost averaging because no one knows when the bottom's in. And I would suggest if you're going to increase risk, look at a plan to dollar cost average into that risk over a good period of time. And we've done that for a lot of our clients. Doing and buying stocks right now and adding to the risk profile of your portfolio is not going to feel comfortable. And it never does. And that's why we're here for you. That's it for this episode. If you need anything, email me, call me. We're happy to help. Thank you for listening to The Lowdown.